Well, today I want to talk about monetary policy. It's been some time since we've been discussing the Reserve Bank. Indeed, when the Reserve Bank made their major policy moves in March, there really hasn't been much to talk about in terms of policy changes. But last week when the Reserve Bank Governor spoke after the board meeting, he pointed out, he added some words that I hadn't seen before, which was, we will consider how further monetary measures may be able to support the economy. That's signalling that they're considering further stimulus. So let's consider what's happened and speculate on what that might mean. Well, for a start, at that board meeting, the Reserve Bank increased the term funding facility for banks by $57 billion. Bear in mind that facility provides banks with 3-year funding from the Reserve Bank at a very attractive 0.25%. But that was an increase in the facility. The total facility is now up to nearly $210 billion. And based upon the formula the bank uses for growing that facility, it could get up to near $300 billion by the middle of next year. So that's a lot of support for around that 3-year part of the yield curve for the banks. Of course, the second support they've been giving is targeting the 3-year bond rate at 0.25%, and they've been very successful in doing that. They've purchased over $60 billion worth of bonds, including around $10 billion of semi-government bonds. And bear in mind that the budget deficit last year, which blew out from $1 billion to $85 billion, compare that with the $60 billion of purchases, and the Reserve Bank's played a very major role in holding down those bond rates with their purchases. When we look forward, we expect the budget deficit for 2020-21 to be $230 billion and probably $150 billion in 2021-22. So the Reserve Bank's got a lot more work to do in terms of supporting the bond market with their quantitative easing policies. That's been having the right impact in the housing market. So that pressure that it's been putting on that 3-year part of the curve with the very cheap funding for the banks and targeting the 3-year bond rate at 0.25% has meant that 3-year fixed mortgage rates have fallen from around 3.5% to less than 2.5%. And that's doing its job. That's supporting the housing market at a time when the economy is in recession. And indeed, the last measure that we saw of new lending for housing, it was only 3% less than the level of new lending that we saw before the COVID crisis. So the Reserve Bank must be feeling pretty good about the fact that their policies to hold down fixed rates are helping the housing market significantly. But of course, for the housing market, there's one big risk that the market is going to be facing. The regulator pointed out that there are $240 billion worth of deferred loans on the bank's balance sheets at the moment, around $170 billion being mortgages and around $55 billion being for small business. So the question is, how will borrowers deal with their mortgages when they have to restore their repayments? How will the banks deal with that? And what will that mean in terms of distressed properties going onto the market next year? So that remains a big question market for the housing market. And if the Reserve Bank wants to continue to support the housing market through monetary policy, and they're worried about a lift in the supply of mortgages, then they're going to have to continue to support demand. And that means maintaining that downward pressure, particularly on that part of the yield curve around that 3-year area where fixed rate mortgages are now proving to be so stimulatory. In fact, some estimates suggest that the share of banks' mortgages now are nearly 25% fixed, up from 20% in recent times. The big question is, will they be prepared to slash the cash rate even further? It's at 25 basis points now, and the governor has indicated he thought that was the effective lower bound. But there is speculation that they could cut that cash rate to 0.1. If they cut the cash rate to 0.1 and they have a 3-year bond target at 0.25, they'll probably have to lower that 3-year bond target significantly, and that would lead to a further downward pressure on that fixed mortgage rate. This is something that is very much in front of mind at markets at the moment. My personal view is that it's unlikely that they would move to such a low rate at this stage. Better to wait to see how the market evolves going forward. It'll also have a very major impact upon some of the reasons why the Reserve Bank has been so opposed to negative interest rates, particularly around the impact upon bank profits. So markets have moved a lot of discussion about the Reserve Bank going even further. My view at the moment being that they will be patient, but it's certainly a very important topic that has emerged quickly and is worthy of considerable attention. Thank you.